Despite the fact that I'm a big NIO bull and long-term investor, I just bought puts on this stock a few days ago, meaning I think it could go down in the short term. And this was before the short report came out from Citron Research on November 13th. In this video, I'll explain why I bought puts and my in-depth thoughts on the Citron short report. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we are talking all things NIO stock, ticker symbol NIO. This stock has had a monster run lately, jumping over 70% in the past 2.5 weeks alone. And I'll be honest, I don't mind the gains, but it's a little scary. We were fortunate enough to get into this stock at $11.80 per share, giving us very favorable returns. So a lot of people in our Discord asked about my opinions on NIO stock lately. I would say this message from November 6th, about a week ago, pretty much sums it up. I think NIO could dip after or around earnings, and it's already begun. I'm not quite sure this recent rise was justified, and I'm holding my shares, but I personally would not buy at these levels. But we have new information now, especially with this new report, so let's get into it. Give me the format. First, why the heck did I buy puts if I'm a long-term investor in NIO? And then second, an in-depth look at the Citron short report and whether or not I think it's valid or holds any water. No time wasted, let's get right into part one. Why did I buy puts on a long-term position? This is a form of hedging my position. Hedging is defined as strategically using financial instruments or market strategies to offset risk of any adverse price movements. In other words, if you're long on a stock, you can use tools like options contracts to reduce your risk of losing gains if the stock price drops. Options in this case could be that financial instrument that you use to kind of combat the downward price movement. So there are several ways to use options to hedge your long-term positions, but one of them is buying puts. Now, I don't want to get too in-depth on options right now, as this video is about NIO, but the main idea you have to understand is that if you buy a put options contract, you're expecting the price of the underlying stock to go down. In this case, on November 12th, I thought the price of NIO would go down around earnings, so I bought 2 puts. Then I bought a third put right here after it kept rising, and to be honest, I got super lucky because it just so happened to be the top for the day. If the stock price does go down, then the value of your puts will simultaneously go up. So even though I lost over $500 in share value on my NIO position after that 7% red day, I actually made money on the puts at the exact same time. And I actually sold the top put, by the way. I just have the December put now. So this is an example of how hedging with a put option might work, but I should note, hedging is definitely not risk-free. If NIO were to keep going up into the 50s and beyond, I could potentially lose all of the money that I put into my puts. But at the same time, I would technically be making paper or unrealized gains on my NIO position with the stock. I feel like we're getting a little too in-depth here, but if you want to learn more about this, you should check out some other channels on YouTube like Project Option or In the Money. Now, I don't actually do this a lot. I don't often hedge my positions like this, but with NIO, I thought there was a high probability that the stock would actually go down around earnings. This is because I thought the valuation was getting out of hand, the stock price was going parabolic, and there was just too much exuberance surrounding the stock in my opinion. So I bought the options to protect the downside, but I'm definitely still long on NIO, but it just so happened that right after I bought my puts, Andrew Left from Citron Research comes out with a NIO short report and a $25 price target. Let's dig into that in part 2. Is Citron's short report valid? It starts by saying 2 years ago, Citron actually recommended NIO as a buy when it was still at $7. But now that it's trading at around $44 a share, they believe this price can, quote, never be justified by its current standing in the China EV market or its near-term prospects. I think it's important that they mention that they previously gave a buy rating on this stock because that means at one point they did see the value and potential in NIO when not a lot of others did. I do think that lends them a little more credibility here, but now there are 2 main reasons why they think NIO is no longer a buy, and the first one is Tesla Model Y pricing in China. They point to an article that suggests Tesla could cut the price of the Model Y in China from about $73,000 US to around the $56,000 to $58,000 range, which would make it a direct competitor to NIO's EC6 and ES6. And there could actually be a valid argument here, seeing as the ES6 model did make up over 8,000 of NIO's 10,331 deliveries in Q2. So any direct competition could be a big hit if demand fell sharply for the ES6. And I think demand might fall, but I doubt it will fall sharply. Instead, I think it might just slow down the growth a little bit. And this is because Tesla suggested a price of $56,000 to $58,000 for the Model Y, whereas the ES6 is selling for $52,000 US. So it would still have the price advantage here. Now, this article is a couple years old, so I tried to find a more recent price. This site, which has to be Google translated, suggested prices that range from about $52,000 US to $76,000 US. But I assume the latter is with all of the specs fully maxed out. And this article from 2019 also quotes the ES6 at $52,000 and upwards of $65,000 for the higher variants or maxed out specs. The point is, if those prices that I found were correct, and please correct me in the comments if there are new prices, but if those are correct, the Tesla Model Y would not really be undercutting NIO at all here. If anything, NIO and Tesla would probably just be more heavily considered by the consumer when deciding which one to buy. But is this a reason to sell the stock if you're a long-term investor? Personally, I don't think so. But is it a reason to think that the stock price might be pricing in too much growth for NIO, seeing as their momentum may slow down a bit after this price cut? Yeah. I actually do agree that the stock price is pricing in way too much growth and it's a tad overvalued, but I'm very comfortable just letting it come back down to reality. I'm not worried about selling here. The worrisome part is that they quoted a different article stating that Tesla's strategy of passing its cost savings to consumers in the form of price cuts could result in a price of just $41,000 US, significantly lower than the $52,000 price tag for the ES6. This is definitely something to look out for, but it kind of seems like from that one little blurb, this is very much speculation at this point. There is now a massive disconnect with NIO trading at the largest premium to Tesla in history at double the valuation. On NTM, or next 12-month EV to sales, NIO is trading at 17 to 18 versus Tesla at about 9. And again, I can actually kind of agree with this. I think in the short term, NIO is a bit overpriced right now. But this is where I have to decide if I'm a trader or if I'm a long-term investor. I think you'll see this theme develop throughout this video, but if I'm a trader, you bet I'm taking profits on NIO right now. That is a no-brainer. However, if I'm an investor, which I am, I'm personally not going to sell NIO for the next several years. My thesis of NIO selling millions of EV cars every year is not yet realized, so why would I sell so early when they're only delivering 10 to 15,000 cars per quarter right now? So yeah, short-term valuation is kind of high, but I don't think it's done appreciating over the long term quite yet. Now, does this mean I would buy right now? Personally, no, but I'm very comfortable holding here. Alright, here they talk about the fierce competition being faced by NIO. They draw the comparison that when Tesla was delivering a quarterly run rate of 15,000 vehicles, similarly to NIO today, Tesla had a 45% market share of US EV markets. That's important, it's US. While NIO only has 3% share of the Chinese new energy vehicle market. What I think they're trying to say here is that when Tesla was producing just as many cars as NIO is now, they had 45% market share while NIO only has 3%. And that kind of shows that NIO's in a much more competitive environment than Tesla was. But to me, this seems kind of a weird comparison to make because it's not proportional. The Chinese EV market is literally triple the size of the US EV market. So what they really should be comparing, in my opinion, is NIO's market share today versus Tesla's market share back when they had a quarterly run rate of 5,000 vehicles, because that would be 15,000 divided by 3, which is again how much bigger China's EV market is bigger than the US's. That way, the market share and deliveries can be more proportional to market size. But even after we make that adjustment, I would not be surprised to see that Tesla still has a much higher market share than NIO does proportionally. And right now, Tesla is the leading EV in China with 23% market share. So yes, NIO is facing some pretty stiff competition even beyond just Tesla. But as a reminder, NIO does have the support of the Chinese government, and they're kind of meant to be the poster child of China's green initiative. Additionally, the Chinese automobile market is absolutely massive. Even if NIO does not become the dominant player, it will likely have a pretty good chunk of the EV market share, meaning they'll produce way more vehicles, likely millions more than what they're producing today. If the EV space was mature in China already, and EV cars already made up the majority of Chinese automobiles, then I'd be a little concerned. But that is not the case. And their final point here on their short paper is the share structure. Citron points out that the investor base, which I believe they're implying is heavily made up of retail investors like you and me, is more interested in spinning a casino wheel. Here, I think he's trying to say that many of NIO's investors, like you and I, have bought into NIO just because they've seen it go up a lot recently, not because they've actually dug into the company and done a lot of research. And the fact that you're here probably means that you are trying to do your own research, but for people who don't, this can actually be dangerous because it can create weak hands, and weak hands can create panic selling. So as we always say on this channel, make sure you do your own research before buying into any stocks. Additionally, he says the float is open and the short interest is almost at a 2-year low, and here I think he's implying that shorts may return to this stock, which could put downward pressure on the stock soon. Again, this is something I'd be more worried about if I were a trader and not an investor. Finally, in the conclusion, he says anyone buying NIO right now is not buying the company. They're just buying 3 letters that move on a screen.
Okay, well now I just feel personally attacked.
Again, he's just referring to people who he thinks are just betting on the ticker symbol NIO because it's been going up a lot. He doesn't really expect us retail investors to be doing research with... Come on. He acknowledges the China EV movement is real, but suggests there are better places to put your money to play this shift. And at the end, he makes a little passive-aggressive stab at the fact that NIO is not yet profitable.
I'll give him that one. NIO is not profitable.
At the end of the day, I tried really hard to look at this objectively, and I ended up agreeing with a lot of what he said for the short term. I hate to sound like a broken record, but if I'm trading NIO, then I agree with this report and I would sell. But as a long-term investor, I do understand NIO has a high probability of dropping in the near future because of the reasons listed in this report, and it's also why I decided to put this hedge on before this report came out. But again, this hedge is just short-term protection for the downside. And here's a fun little piece of history. Andrew Leff shorted Shopify on April 4th, 2019, saying it deserved to be a $100 stock. Obviously, Shopify is now at $900 a share, so another reminder to always do your own research. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, check out a quote of the day, you might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. If you're watching at this point in the video, you are the real MVP. Don't forget your peace, and thank yous.